Welcome to handout 14. In this handout, we're going to be looking at what's called the cost of capital for entities. And that's going to be a set of discount rates, one for debt projects and one for equity projects that we're going to start using going forward when we apply things like the NPV method to evaluate a company or a company's debt. And sometimes when we're looking at debt, we'll use the IRR method instead of the NPV method. The other thing we're going to be doing in this handout is looking more closely into the tax shield effect. And the tax shield effect is it mitigates the problem, the added expense of interest when you take out debt on your bottom line, on your net income. And we'll see how that works with a couple of examples. All right, so with that, let's not waste any more time. Let's just jump right in. Okay, so here we are in handout 14, which is going to be all about costs of capital and tax shield for entities. So as usual, let's jump right in. I want to start out with a few reminders. Remember, we're using mostly NPV method now to evaluate projects because it's the most robust method. It always works, things like that. The IRR method is, however, very good for things like bonds and loans and mortgages, mortgage loans, etc. Okay, so with our NPV method, the cash flows we've been using have been the risk-adjusted project cash flows, and we've been discounting with our opportunity cost of capital, or just cost of capital for short, which we've pretty much developed through the opportunity investment model. And our definition for opportunity cost of capital from that model is our known interest rate for a diversified set of alternative projects with similar market or industry risks. And another reminder, final reminder for today, is that we've needed a whole bunch of assumptions. Okay, to make everything work, I don't need you to know what all these assumptions are. All I do need you to know is that to make any of these models work that have anything to do with the future, we need a whole bunch of assumptions. Okay, so with those reminders in our back pocket, let's move on to costs of capital for entities. And in general, entities have two costs of capital. One is going to be for debt, right? If they borrow, if they issue bonds, things like that. And the other is going to be for their stock, if they issue new stock, et cetera, et cetera. So key thing here is that both of these costs of capital are interest or discount rates. Okay, so even though we say cost of capital, we're always talking about an interest rate or for debt, or an interest rate or discount rate for equity. So let's look, for example, at what we mean by this in the case of debt for an entity. Let's say we have a company who wants to borrow $1 million to develop and market a new product. Okay, so clearly they want $1 million in debt capital for this project, and they go to JP Morgan Chase and they get a $1 million 5-year 5% interest loan. And to keep things simple, let's say there are no fees associated with this loan. So in that case, we would say the cost of capital for this project, for them, for developing this new product, is 5%. And maybe even a better way to think of it is that the company needs to pay an interest rate R of 5% to get this capital, and that's going to be their RD for this project. So let's think of how this could work in the case of equity capital. So I'm going to do a simple, unusual example, but it is nonetheless a realistic example for what are called special purpose entities. So here's how it works. Let's say we have a startup company that wants to issue $1 million or 1,000K worth of stock, and that's going to be all the stock for the entity. And it wants to get that money so it can establish a black box that it believes that it hopefully will provide the owners, the shareholders, with an estimated 100,000 in dividends for 2 years. And then at the end of 2 years, the company will be liquidated. So that means its assets will be sold and its liabilities will be paid off. And the startup company management believes their best estimate is at that time, after they've paid off all the liabilities, they'll be able to return to the owners another estimated $1 million. So this is typical type of thing for what's called a special purpose entity. It's planned to have a finite life, and et cetera, et cetera. So in this case, the cost of equity capital is coming from the shareholders requiring that equity investment to grow at an estimated rate of RE. So they're doing that in return for participating in the project. They're demanding that the money they put in grow at RE%. So it works like this. So they put in the 1000K now, okay, and that's going to translate to a tranche A growing at RE% to an estimated 100 in a year, and a tranche B growing at RE% to an estimated 1,100K in 2 years. So we can, with this knowledge of what the projected cash flows are, we can solve for the interest rate that equity investors are going to demand to participate in this project. So let's go ahead and do it. So my 1,000 here is our PV total, okay, and that's equal to 100 divided by 1 plus RE raised to the, let's keep all our time units in years, raised to the 1 plus, then at the end of 2 years, they get 1,100, and we've got to discount that back by 1 plus RE raised to the 2. So let's plug this into Excel and see if we can find out what RE is equal to. Okay, so we could solve this using the quadratic equation, we could solve this using trial and error, we could solve this using a financial calculator. I'm going to try trial and error here. So I'll take as a guess for RE 10%, and I'll put that in here. I'll put that in here, and it didn't like my comma up here, and it's changing that, so that's fine. And I do get 1,000, so you can see 1,000 is equal to 1,000 if I use the correct RE of 10%. So what does this mean? This 10% is the growth rate, the interest rate, okay, that the startup has to promise potential investors in order to attract them to participate. Okay, so note, okay, no contract, okay. Nothing is guaranteed in this case, okay? That's unlike the situation for debt where there is a contract and JP Morgan is going to get its 5% unless the company defaults on the contract. Completely different situation here with the special purpose entity. This is what the equity investors are hoping they're going to get. This is what the management of the startup hopes to provide them, but absolutely nothing is guaranteed. And if the equity investors don't get this, they can't take over the company, they can't sue the management, that type of thing. So now going forward, our DCF valuation models, when we're looking at them, and again, NPV is going to be our main one, we're going to adjust things a little bit. So our ROCC will still be the cost of capital for the project, and depending on whether it's a debt project or an equity project, our cost of capital will be RD for debt projects, and our cost of capital will be RE for equity projects. And we're going to start using new techniques to find our opportunity cost of capital for debt and equity projects instead of using what we've used before, the opportunity investment model. And also, as was the case in previous chapters, our opportunity cost of capital will also sometimes be called RM. RM stands for our market. So we just want to remember that. So now let's take a deep dive into the cost of debt capital for entities. The first thing we want to know about this is that there are two main measures of the cost of debt capital for entities. We can measure the cost of debt capital for entities on a pre-tax basis, And that's easy to understand because it doesn't include any effect seen on the income statement. So if we're ever measuring cost of debt capital and the income statement is not involved, then that's going to be a pre-tax measure, okay? And what we're going to see when we get to the income statement is there is what's called a tax shield effect of using debt capital, which is going to reduce what the entity pays in taxes. But we'll get to that in a bit. The second way to measure cost of debt capital is post-tax, and you're always going to know if you're dealing with a post-tax cost of debt capital because it's going to involve one way or another some information from the income statement, and that, of course, is going to include the tax shield effect. So in general, our RD pre-tax is always going to be greater than or equal to our RD post-tax. And that's going to be because of this tax shield effect. Okay, so let's look at several pre-tax measures of our cost of debt capital. In general, if we're looking at a single project, like we did with the JP Morgan Chase example up above, the cost of debt capital is the IRR for that project. And that's going to be computed using promised contractually specified cash flows. And remember, the IRR is the discount rate, interest rate that makes this true. It makes the NPV equal to 0 when we plug in the right value of the IRR. And IRR is a really good thing to use because it captures all of the project's cash flows, including upfront fees, back-end fees, etc. So it may look, in other words, like a bank is charging you 6% interest on a loan, but if it's also charging you a big upfront fee, effectively it's charging you a higher interest rate than that. And that true higher interest rate is always going to be captured by getting the IRR for the project. So that's why we use the IRR. So let's look at a bond example. So let's say Superco here issues some 3-year bonds with the promised cash flows shown. So they're going to get 100 for each bond, and in return, they're going to give $10 interest, $10 rent on that $100 for 3 years. And at the end of the 3 years, they're going to pay back that principal amount. And the company is issuing 10,000 of these, so they get $1 million total. Okay, hooray for them. That's great. So we want to find out what their cost of debt capital is for this bond. So what are we going to do? We're going to take these beautiful cash flows and we're going to find the IRR. So we've got to use our IRR equation here, okay? And just because I've got early onset Alzheimer's and all that other set of problems that comes with age, I've got to look back here. So I've got my 100, 10, 10, 10, and then 100 in the 3rd year. So I think I can figure this out now. I think I can remember that. Okay, so plugging in now to our IRR equation, I have 100 minus 10 over 1 plus IRR raised to the 1, and then our second interest payment, 10 divided by 1 plus IRR. I need to discount this payment back by 2 years, so that's going to be raised to the 2. And then finally, our third interest payment and principal gets paid back. So the total there is 110, and I need to discount that back by 3 years. Let's bring it over into Excel and see what we've got. Okay, looks good. And I did a little sneaky thing in here in Excel. I typed in IRR equals, but more importantly, in C10, when I got into C10, I just went up here and typed in IRR and hit return. So now for this spreadsheet, the Excel thinks whatever is in C10 is equal to IRR. So I make it 15%, it thinks it's 15%, and that's kind of nice because then I can do this. Okay, and when I have my IRR equal to 15%, I get something that's not 0. And if I put in 8%, I get something that's not 0, but the sign has changed. So I know it's in between 15% and 8%. So I can say 12%, so it's still in between there somewhere, and I can pretty quickly get to 10%. Okay, so this is clearly not something I'd ask you to do on an exam because I don't want you to spend too much time with trial and error, and you can't use the quadratic equation on this one. But for our purposes here in the lecture, it works really well. So the cost of capital for this company, for this bond issuance, is 10%, okay, which we found by using the IRR technique, and the 10% is the IRR for this project. Another way to think about this, okay, is that the 100 that someone pays for a bond now is equal to 3 tranches of cash, right? One tranche of $9.10 that the $9.10 is going to grow into 10 after a year, and another tranche of $8.26, which is going to grow to $10 after 2 years, and then a final tranche of $82.64, which is going to grow into 110 after 3 years. So this is a very good way to think about it from the bond buyer's perspective. I give you 100 now, it's growing at 10%, and of that 100, $9.10 going to grow by 10%, give me 10 in a year, and et cetera, et cetera. So I think this is a very helpful way to think about this. So now let's think about weighted average cost of pre-tax debt, okay? Many entities, most entities, I would say, really have more than one debt contract alive at any given time. So we want to be able to compute their total weighted average cost of debt capital when that's true, and when we do have rather access to all of the entities info, i.e. that means i.e. all loans, bonds, and the contracts for these, so we know all the details. So then we can get, if we know all this stuff, we can get their pre-tax total cost of debt. It's just going to be equal to the weighted average for all their debt contracts. So it's going to look like the cost of capital for project 1 times the principal of 1, cost of capital for 2 times the principal of 2, et cetera, et cetera. So for each one of these, we'd have to get the IRR to get the cost of capital, and then we can use this weighted average formula to get the company's pre-tax weighted average cost of capital. So let's do it in an example here where a company has a $2 million, 8% bond maturing in 5 years outstanding, and they have a $5 million loan with 6% IRR maturing in 6 years, and 20 million mortgage with 6.5% IRR amortized in 12 years. So we can, just by taking a weighted average, we can get the total for the company of their pre-tax cost of debt capital. So that's going to be 8% times 2 plus 6% times 5 plus 6.5% times 20, and that's going to be over the total amount of debt, which is equal to 2 plus 5 plus 20. And I'll leave you to work that out, but if you work it out, I got 6.52%, and you should too. So this is how we get the pre-tax weighted average cost of capital for an entity when it has more than one debt contract outstanding. Now, sometimes, especially if you're going to be an equity analyst working for a mutual fund or hedge fund or something like that, you may not have, and you probably won't have, access to all of the debt contracts of the entity, but you will, as usual, have access to the entity's financial statements. So you can still make a good estimate of the cost of debt capital. So here's the way to do it. The weighted average cost of capital for the entity can come from the income statement and the balance sheet, okay? And you want to do this all on yearly basis. So I've got here for a company balance sheet from year 1 and year 2 and income statement from year 1 and year 2. So let's see if we can get their cost of capital. Okay, so for year 2, I want the interest expense in the period. So that would be year 2. So I just go to the income statement and I get that 100. Okay, and I need to divide that by the debt at the beginning of the period. So what's the debt at the beginning of year 2? If we're on the balance sheet, it's going to be end of year 1. Remember, balance sheets are always done at the end of the period. So I want the 3,000 here, not the 4,000, because this represents the interest that they paid on the debt they had at the beginning of the year. So I divide that by 3,000, and that's about 3.33%.